Hi everyone. A little bit over a month ago, I told you guys to forget Nvidia and to buy another stock. Since then, Nvidia is up about 23.55%, and the stock I recommended is up nearly 74%. So a huge outperformance. Today, I am here to introduce the next stock that once again is in the same section as Nvidia in the sense that it relates to AI and data centers. I believe it is a better play, and I'll get into the reasons why. But first, I want to share a story. I started my journey trading/investing in 2018. Looking through the NASDAQ components, I stumbled upon Broadcom. I saw that it had quite the correction due to some news, and looking at the news carefully, I determined it wasn't all that bad. So I essentially went long, and I recommended one of my family members to do the same. Today, Broadcom is a leader and most know it. Since that time, it has went up by about 12 and a half times. But essentially, why I bring up this story is because it's a little bit similar with Marvell Technologies. And I say that because the company hasn't really had problems. Yet the sentiment has really driven it down, and it hasn't recovered like the other chip stocks. The main reason is because, as you can see, they have an AI investor event for 2025, which was today, and it was meant to be an investor day. Because they pushed out their investor day to next year and held an investor event instead, people just kind of thought, maybe they have nothing to show. So looking at their investor event, I'm not going to go through everything because I'd be wasting your time. But just skipping to this slide, essentially, you're looking at a larger total addressable market. You're seeing that, they're looking to increase their share to 20%. They're winning these so-called sockets, and they have more customers, so it's more diverse. So if you guys want to listen to it, I'll link this below, but it's quite long, so you probably don't want to. But essentially, the similarity with Broadcom is it's not that logical of a move, in my opinion. And speaking of Broadcom, Broadcom actually happens to be their biggest competitor. And I think this is a better buy. Why? Broadcom is probably superior in some ways. But if you look at Broadcom, they're trading at a P about 94, right? And yet their top line is growing, the most recent quarter, 20%. And bottom line, 134%. So if you can remember those numbers as I take you through Marvell, the PE ratio, there's no PE ratio because they're technically unprofitable. And it's I say technically here because, that's GAAP, but I've adjusted their PE ratio to about 58, and the adjustments I did was essentially adding back the amortization of acquired intangible assets, restructuring related charges, and that's how I got the PE of about 57. Now, I don't really like adjusted PE because a lot of them add back stock-based compensation, and Marvell does that too if you Google it. So I didn't add that back in my calculation, but I do think it's fair to add back a couple things just because, being unprofitable due to something like amortization of acquired intangible assets is pretty meaningless in my opinion. So, technically they have no PE, but I'm adjusting that to 57. So you're looking at it cheaper on a trailing 12-month basis than Broadcom, right? And if you look at the top line, we're looking at about triple the top line growth, in the recent quarter, and 50% more net income growth. So that looks a lot better. Another thing I'd like to mention is I do believe there is significant alpha to be gained just by front running potential index inclusions. This is a very high quality, big, and it's been around for a few decades company. So I believe very, very soon, maybe not very soon, but within a few quarters, this is probably an S&P 500 component. So if you think about Wall Street, they have all these billions of dollars, trillions of dollars. And the issue is they have to be very concerned about deploying that money, because how can they get in and also how can they get out? Which is, it's pretty simple. The fact of the matter is there's nothing better when it comes to exiting than passive index funds. Because, while they're trying to sell on any other stock, they might accidentally turn the tide and cause, some issues and ruin the sentiment. When it's forced S&P 500 passive investors at any price because it's been let into the index, well, there's nothing they can really do about it. So I think Wall Street does want to front run these. And with Marvell being, a very suitable future component, very high quality, I think this is a very good long. And, especially because most stocks are at a pretty elevated point right now. But yeah, that's all for this video.